All right, we're going to start today with looking at the S&P like we usually do. You can see um, 2 Mondays ago, we had a 5% drop in the stock market due to some fears from geopolitical issues with the yen carry trade. Um, one thing you'll notice is that whenever we have crashes in the stock market like that, we very, very often revisit the lows. Um, so this 517 we had here in this crash, a lot of times we revisit that low to confirm that that we have a bottom. If we go back in this chart to maybe 5 years, let's look at 5 year chart. Okay, we can see the pandemic. Okay, so you can see we had a couple bottoms here. We had a bottom here, and then we revisited that low. We didn't revisit a low during the pandemic because we had huge amounts of stimulus coming in, and that kind of allowed the stock market to keep going up and up and up and up and up until we hit this top here. But a lot of times, whenever you have that crash, you have a retest of that low. So we're gonna keep that in mind as we go into the worst month of the year, September. I'm not saying that's going to happen. I'm just saying don't be surprised if that happens. Okay, so now let's look at our meeting notes. Okay, you can see right now we're pretty much done with most, like 90% of the stocks in the stock market have reported their earnings. We have one big report coming up the 28th. That's 2 weeks. NVIDIA. So the whole stock market and all the AI stocks, they're all waiting for that. And that could be that could propel the stock market higher or um, make it go lower. So that is something everyone's waiting for. I have September marked as red because we can see in our average monthly stock market returns for the last 40 years, September's been almost a lot of times negative. So 0.7% negative on average. So because of that, we're not expecting much of September. And when we're kind of planning out our purchases, it's probably better to wait after September to make any purchases. All right, so let's look at some of our talking points. All right, we had the stock market go up 3% in the last week. That is pretty good. That's one of the best weeks since last year or for a long time. And the reason for the stock market going up, we were basically oversold with this. Let's see, let's look. Okay. We were basically super oversold, and the market basically got back everything it lost during that crash. A lot of times, whenever you do have a crash, the worst thing to do is to sell whenever the stocks are going down. Number one, you get a bad price because the bid and the ask are not fair for the consumer doing a purchase or a sale down there. Second thing is, stock markets usually bounce back after a crash within a short amount of time. This was actually a week it took to go back to normal. But the stock market for the COVID crash, it took a couple months, but and there are some crashes that takes much longer to come back. But for the most part, it's not your best interest to sell when the stock market's going down a lot, especially if you consider yourself a long-term holder. All right, so let's look at some more of our meeting notes. Okay. First of all, we're gaining momentum in the stock market. We are 72% of the S&P is above the 200-day moving average. That is a pretty good sign of momentum. On top of that, we do have the S&P above all of the moving averages, the 50-day, the 100-day. You can see this is the 200-day, the 100-day, the 50-day moving average. So, and because of that, we're probably eventually that could give us momentum to go back up into this channel. But remember, we are approaching the worst month of the year in September. All right, so now, let me see. Catalyst for the stock market to go down. Any surprise with interest rates? Right now, everything is like a Goldilocks scenario for stocks. Everything is coming together. We're not going to have a recession. We had a very strong report from Walmart this week. We had Walmart reporting on the 16th, and they had really good earnings showing the consumer is very strong. So people were worried last week and the week before about possibly going into a recession because of employment concerns, but not anymore. So let's look at some more. Okay, for our S&P 500, you can see we're getting to a point where we're near overbought. We're at 68 and it's going up. So we have a little bit more to eke out before we're overbought. We're basically above the 50-day, above the 200 and the 100 day moving averages. We had a inverse correlation between the stock market and interest rates, the interest rate for the 10-year for a long time, very close to a year. And that unwound in the last 2 weeks. But this week, it started up again, this inverse correlation. So we had this bad news is good news for a while, where if the treasury is going down, that in yield, that usually indicates that there's going to be a recession, or no, there's going to be, well, okay, yeah, so if the interest rates go down, that means that the cost of lending goes down for stocks. So that's why stocks would normally go up. But if there is a sign of a recession and the stocks go down when the treasury goes down, because in general, if there's a recession, the stock market earns 15% less or so whenever the consumer isn't spending and when there is less economic activity. All right, took a while to get that together. Now, reviewing the major variables in the stock market, we have the price of oil going down. We have a lot of geopolitical issues. We have wars going on in Europe, and you would figure the price of oil would respond to that and go up if the supply of oil goes down over there, but that hasn't happened. And so right now, basically all the variables are kind of constant or not doing a whole lot of moving around. We had the price of gold go up 5%. That could be because a lot of the countries around the world are buying gold instead of US Treasuries. Because a lot of countries, like the BRIC nations, they are against the dollar, are using the dollar. So perhaps they're using gold instead of um, the dollar for their investments. So maybe that's why it's up. But let's see. The US dollar has been basically sideways. So right now it has a no effect on the stock market because if the currency is the same over time, then multinationals don't have a problem when they repatriate the money coming in. All right, let's look at the fear greed index. Investors are less fearful this week. They were extremely fearful last week. That's when we were saying it's time to buy, hold your nose and buy or don't sell. But now people are just basically fearful. Um, let's look at the AAII sentiment survey. Amateur investors are bullish right now, and they're less bearish than last week. So, all right, so bullish is you have to be very cautious. If everyone's bullish, I'm not sure if this is actually updated correctly because you'd think that people were fearful to go along with this fear, but we'll take it for what it is. Okay, the VIX. You can see this VIX spike that happened on Monday, 2 weeks ago. That was basically one of the largest volatility spikes since the COVID crash. So there was extreme fear in the market at that time. That's probably the best time to start buying something. If we do see this again, which we might this summer, if we go back to those lows, we might see another spike. It might be a good time to start looking for quality stocks. And I have an article later on um, where there's a analyst that told us his formula for picking stocks that are very, very reliable in the volatile environments. Okay, so but right now we're back to 14 in the VIX, which is pretty low. People are complacent and not fearful. Okay, so we're about right here in the sentiments, um, the emotional graph of, I don't know if I've explained this in a long time, but basically the emotional graph is these are different phases of an investor. So if you're an investor, you hear things on the TV, you're excited, you have media attention, you have AI in the news. Okay, you get enthusiasm, then you get greed, you get delusional, then you want to buy more, buy. And then right when you think you have it all figured out, the stocks start going down a little bit in the of denial. These are the emotions of a typical investor. Return to normal whenever it goes back up a little bit. Fear, capitulations. Typically, whenever you have a capitulation in fear, investors that are um, have a tendency to want to sell whenever there's capitulation. And you don't want to do that. You want to be neutral as an investor. You don't want to get to a point where you're just desperate and have despair. Um, and then as soon as you go past these, then you go back to the normal, and then you're you're enthusiastic. So we have to keep in mind things that could lead to a crash. And I highlight things every now and then. We still have um, 10 years of low interest rates in Japan. People have been taking advantage of that. So we still might have some yen carry trade issues where maybe a bank goes under or a bank that has been doing this yen carry trade for 10 years finally realizes they're not liquid. And if that happens, we will capitulate and have despair. Um, but I'm not counting on something like that because I'm a long-term investor and I know that's just a bump in the road, but you keep going, your car keeps going. Um, all right, so we're basically at the end of earnings report season, so we're not going to have earnings reports for the next 2 months. We have a Fed meeting and we have economic reports. That's about it. That's why we have basically a very slow um, and usually negative time in September. Okay, so let me see. Okay, we're keeping track of our worst to first. Last year, we had IT, communication services, consumer discretionary as the best, healthcare, energy, consumer staples, utilities as the worst. And we can see that the worst from last year are turning out to be a very good sectors this year. You can see that utilities up 17%, staples 13%, financials up 16%. We still have an outperformance of IT and communication services, which went up 5% this week almost. Okay, so we see. We still have two themes that are taking charge in the stock market right now. The weight loss drug companies, Eli Lilly and Novo Nordisk, have exploded this year and they're doing really good. And the AI revolution has made a lot of the AI stocks go up. So, let me see. Okay, let's look at some of the sectors that are going up and down today. You can see the 10-year is going down, so we expect any sectors that are sensitive to interest rates to be affected by this. So if we have, let's say, home builders, when interest rates go down, they can sell more houses and they're more profitable because more people can afford the houses. So let's look at see if now what other sectors are sensitive to interest rates. Small cap stocks. Whenever interest rates go down, any company that needs to borrow money will do better. So let's see if that is showing in our sector ETFs. The ones that did the worst, the home builders did the worst. With lower interest rates, I thought they would be doing the best, but they didn't. Let me see. Energy stocks are doing the worst. Oil stocks, perhaps that's because the price of oil, the price of oil actually went up a little bit today. So let's look at the sectors doing the best. Gold miners. We saw the price of gold going up. That's a good reason for the gold stocks to go up. And maybe it's because of all these central banks around the world buying gold instead of the U.S. treasuries. Okay, so we have the regional bank ETF doing good. Banks are very sensitive to interest rates. We have the S&P, let's see, utilities doing better because let me see, whenever utilities have whenever interest rates go down, any high yielding investment will be going up because if the interest rates go down, then the utilities, which pay a large dividend, there'll be more demand. And okay, so we have tech going up a little bit today. All right, so that explains the sectors. Okay, now we're going to go over Some of the market movers for today. We have Ulta Beauty. This is the stock that Warren Buffett's company, Berkshire Hathaway, started accumulating a small position in. It went up 12% yesterday. Now it's up another 3%. It's a blessed stock. Whenever Warren Buffett buys a company or mentions a company or um, says something about a company or buys parts of a company for his Berkshire Hathaway portfolio, it is blessed, and a lot of the stock market follow what he does. So we have I don't see any connection here. We have Tapestry. They had a good earnings report. Um, we have okay. I can't see any other combinations there. The ones going down the most, Chipotle. Chipotle had a CEO switch with Starbucks. The CEO of Chipotle went to Starbucks, and that cratered the stock of Chipotle because that CEO did a very good job at Chipotle. But Starbucks went up 24% on that news. And Chipotle is still going down because of that. Palo Alto Networks is going down. Um, mm, I don't see any. Oh, we see Eaton Corporation. They do a lot of the infrastructure for the electric grid. So that's an AI play. We have Train Technologies, which is I don't know if it's related to any of these. Lam Research, KLA Corp. These are all chip companies. So that's there's they supply materials to the chip manufacturing companies. All right, that was a good little excursion. See if we can see any. Okay. A lot of AI plays going down today. We have um cybersecurity company, Applied Materials. Okay. Another Applied Materials is another company that does they give materials to some of the semiconductor manufacturing places. Okay, so we have Datadog, and they're a provider of services for the cloud infrastructure. So, and Palo Alto Networks, their cybersecurity. So we have a big bunch, a lot of companies involved with the infrastructure of data centers going down today. All right, that was a good excursion. Let us go back to our talking points. All right, so where are we here? Okay, so let's look at the earnings. Okay, these are the earnings that happened this week. We had Home Depot, UBS, Cisco, actually had better than expected earnings. Home Depot had a mixed quarter. Walmart, they did really good. Um, the report from Walmart was important because it showed that the consumer is doing really good and they're still spending. And there's a lot of people, we've been saying it for a couple of weeks now, they're trading down. So the people that would normally shop at Target or Nordstrom's, that make 100,000 a year are now shopping at Walmart. So that's why Walmart did good and why it's such a great stock to own in this kind of environment. Okay, let's look at earnings for next week. We have the important ones. These are all kind of no-name stocks. They're smaller. Lowe's is important because it gives you a hint on how the home owner is doing. And Toll Brothers, that gives you a hint of how homes are selling. Um, Homes and home purchases is a big part of the economy. Target, that they're going to report, and they're going to give a hint on how the consumer is doing. I'm thinking they're not going to get they're not going to have a great report because Walmart it did so well, they might have eaten their lunch. All right, so let's look at a chart of interest that I found. Walmart. You can see that this has a perfect upward trajectory and well-defined trend lines. It went to the exact top of the trend line. It went up like 8% the day of the earnings. So um, it's basically overbought right now. Um, okay, so there's a story that Buffett Buffett's Berkshire added to Ulta Beauty Heiko in second quarter. So these are two stocks that are blessed by Warren Buffett. And we saw Ulta Beauty um, in the top performers recently um, as a stock that is doing good. As soon as they announced that they're buying the stock on Saturday, these stocks jump because everyone admires Warren Buffett and there's a lot of people that follow all of his trades. And sometimes whenever we're looking for a stock and we do some screens, sometimes we find a stock before Warren Buffett buys it. And that is the ultimate feeling whenever we follow his techniques. And if we can pick a stock and then he buys it a year or two later, that is the ultimate compliment. I happen to have bought Apple 2 years before Warren Buffett started buying it. So I have that one thing to be proud of. So let's look at let's look at Ulta Beauty. Ulta Beauty had a really bad chart. Look, it's been going down since probably the beginning of the year, and it was oversold, and really this is like a really poor looking chart. But as soon as Warren Buffett announced that he's buying Ulta Beauty, it went up a lot. So what we're going to do is we're going to look at this to see if it has any credence and see if it matches some of the Warren Buffett principles that we're looking for. Okay, so these are the statistics of Ulta Beauty. Hold on. A minor technical difficulty. Hold your horses. These new features on Adobe Acrobat, I accidentally pressed this create button, and now it's going through this thing. They want you to use these AI assistants and buy their products, but I just want to look at a document. Okay, we're going to terminate this and start over then. Okay, we're back in business. Okay, we're looking at Ulta Beauty. All right, so Ulta has a forward PE of 12.8. That is pretty low PE. PEG ratio is 1.51. So Yahoo thinks that it's 1.5 times overvalued. Return on equity is 58. That is super good. And profit margin is barely at our range of minimum. Total debt is reasonable. It's 1 billion out of 15 billion. So, we have all the pieces here. It's not as great as some of his other picks. Let's look at some of the growth prospects of this stock. Okay, so from this year to next year, it's growing negative 1.4%. So it's not growing at all this year to next year. That could be the reason why it's down in the doldrums. It is the estimates are they're going to make less next year than they are this year. I wouldn't think that Warren Buffett bought this stock. It must have been one of his deputies. It's scheduled to grow 9% for the next 2 years and then 15% after that. So the forward PE the stock is around 13, growing at 9% if you ignore that they're going to be making less next year than this year. So their PEG ratio is 1.5. So it's 1.5 times overvalued. Usually Warren Buffett tends to pick a stock with a very low PE, and that matches what we're seeing here. It's the 13 is a pretty low PE, but he's overpaying for this, and it has a year where it's not growing, and it's a very fickle industry. These Ulta Beauty is it's a place where you spend money on makeup and getting your hair done and things like that. So I think and that industry didn't do very good during the pandemic. So it's not that robust of a business. Um, I'm very surprised that he bought this stock. The tailwinds, things that are helping the stock. A lot of people are trying to look good on their Instagram, social media, and they're encouraging beauty spending. If you look at TikTok, you see a lot of people following trends. Um, that encourages, use of Ulta Beauty's products. Headwinds, things that are bad for the company, their gross margins are decreasing and they have a poor growth forecast. So, um, I'm thinking Warren Buffett's deputy. Warren Buffett didn't pick this. This is not a stock that he would buy. Must have been one of his associates. I wouldn't buy it. I if a stock has negative earnings year over year, that is just a red flag and very inconsistent. So anyway, let's look at the next one. Next one is Heiko. Um, and this company is actually, you can see their growth is a little bit more regular. They're growing like at 13% if you average all these out for the next couple of years. So their forward PE is 55. That is really high for a Warren Buffett stock. Warren Buffett likes to buy stocks around the 12 PE or 5 PE. He bought this one, his company bought this one. Its PEG ratio is 4 and it's 4 times overvalued. Another stock I concluded must have been purchased by someone that's not Warren Buffett. It's not that great of a stock. I wouldn't follow him on this one. Um, okay. And you can see by the statistics that Yahoo agrees that its PEG ratio is pretty high, 3.4. So Yahoo thinks it's 3.4 times overvalued. Profit margin is okay at 13, and return on equity is 14, which is our bare minimum. And the debt is reasonable. I wouldn't buy this one either. It's not exciting. Um, all right, but this is the time of the year when companies, every quarter, companies have to report the things that they've been doing and what's known as a 13F. It's a report. If you manage more than 100 million in your mutual fund or home office fund, if you manage more than 100 million, you have to report your top holdings. So everyone looks at Bill Ackman as a person who really is good at picking stocks. He is a disciple of Warren Buffett. So whenever he buys a stock and loads up on a stock, everyone watches. So he actually bought 3 million shares of Nike. And Nike its stock is basically went from 120 down to 70s in the 70s now. So I'm going to look at Nike to see if it has any credence. You can see the stock of Nike down. Look, this is like one of the worst charts I've ever seen. This could be a catalyst to get the stock through this um, downward trend. But let's look at the fundamentals to see if it's even worth looking at. You can see the forward PE is 25. That's a pretty high PE. PEG ratio is 1.8. So it's almost double the price that it should be. That means, um, let me see. So the profit margin is 11, and the return on equity is really good at 40. So return on equity at 40 means they're probably making their shoes for 25 cents and selling them for $100. That's how you get a really high return on equity. Um, Now Nike, I looked at their growth. Look at this year over year from this year and to next year. We have another stock that's losing money. They're going to be making less money next year versus this year. That's a negative 21% drop. No wonder Nike is down so much. Their forecast for next year is really bad. But what Bill Ackman is probably thinking, they have a very good franchise. They are the number one shoe manufacturer in the world and apparel combination. So that number one um, is probably why Bill Ackman can look beyond this first year of negative 21 earnings growth, so that he can actually hold the stock long term and realize like a 14% annual return after that. But the PE is 22. It's grown at 14%. If we ignore they're not growing next year, then the PEG ratio is 1.5. That's overvalued by about 1.5 times. So the headwinds, things that would help the stock, the Olympics had Nike all over it for advertising. That'll give it some near-term momentum. They cleared all their inventory problems from the pandemic. And they're doing another headwind, things that'll help them are they're converting the people to order online instead of through a Foot Locker. So that direct to consumer is how they're going to grow going forward. Things that are going to hurt the company. Number one, they had their margins. Let me see, they have new competition. There's a lot of new footwear manufacturers coming out like On. And so I don't know. I would wait for this stock to drop to its fair value, which is 1.5 times lower than where it's at right now. So divide 83 by 1.5, that's where I would buy it. I'm just not excited about waiting a year for the stock to grow. All right, so like I said, this is the time of the year when all of the mutual funds and money managers come out with their top holdings. And I thought it'd be a good time to review some of our favorite mutual funds. The first fund that I admire a lot is Contra Fund, a Fidelity Contra Fund. And what I did was I compared the holdings for the fund in the year 2021 to 3 years later, right now. And you can see that they got rid of um, Salesforce, Visa, Adobe, and Netflix. And here are the actual top sales and the top buys this quarter. They bought NVIDIA, Meta, Eli Lilly, and JP Morgan. So the ones they sold the most were Apple, Google, Adobe, Microsoft. And so it's important to keep track of these things. Um, I think it's good. Let me see, hold on. Okay. I think it's good to understand what the mutual fund managers are doing, because if they're holding Meta for 10 years and they're holding Amazon, they're holding Microsoft, and they're even adding to that position, there's a good chance that if you buy and hold that stock in your portfolio, then you'll have pretty good returns. Um, I'm going to okay, I'm going to explain real quick um, the difference between managing your own money and allowing investing in a mutual fund. The difference between buying individual stocks versus buying a mutual fund is two things. One is it's easy to buy a mutual fund because they make all the decisions and you don't have to deal with the buying and selling of stocks. But mutual funds usually have fees involved, like sometimes 1% fee, or even if you pay an advisor to invest your money for you, you pay a fee such as transaction costs or maybe 1% of your portfolio. So what I did is I simulated in this calculator here the returns you would get if you had a 1% fee. So this 1%, the reason why I own individual stocks is I want to avoid paying this extra 1% to someone to manage my money, whether it's a mutual fund manager or an advisor. So if we start with $100,000 investment in and we grow at a typical percentage for a stock or a stock market is 10%. It's like an average growth. If you had an advisor or a mutual fund that took 1% from that, you would only earn 9% growth. So if you start with 100,000, I have a theoretical add 50,000 a year to that contribution, and then year end you'd have 160,000 um, if you didn't have that extra 1%. But if you paid an advisor, you'd have 159. But what you see is after a good portion of years, let's go down to 20 years later, you have 300,000 more dollars if you manage your own stock portfolio versus paying someone 1% a year. And that actually, if you go down like 30 years, you can see it's a difference of 26 million versus 35 million. So That's why every percentage counts. And on top of that, if you own a mutual fund, you have to pay distributions at the end of the year. So these mutual funds are buying and selling stocks all year long. At the end of the year, regardless if you have a gain in that fund or a loss, you have to pay usually capital gains taxes. And if you have a IRA account or a if you have a retirement account, you don't have to worry about that. But if you have a regular account, then you have to pay as if you made that money that year. So that compounds the problem of having a mutual fund in a taxable account. So the reason why I'm spending all this time here understanding stocks is that over time, that 1% that you would normally pay someone to invest for you, that adds up to a lot of money after 20 or 30 years. You would have it 8 million, 9 million, 10 million versus 8 million, after 30 years, etc. So that was interesting. So we're going to go through a couple more of these mutual funds that updated their holdings. Let's go over Magellan. They're one of the largest. Okay, so Magellan, they got rid of Apple, Procter & Gamble, MasterCard, and Home Depot, which they had in 2021. And they added NVIDIA, Broadcom, Eli Lilly, Costco. So you can see that Eli Lilly is in a lot of these mutual funds as a new stock. And that's a very good hint that it's a stock, that it's a quality stock, and they're growing, and they're probably going to hold them for a long time. And Broadcom's a new stock that's showing up in a lot of these mutual funds. Broadcom, they're a big part of the AI story because they provide software like VMware for the data centers, and they're making chips also. So we see Costco too. This is interesting. That shows up a couple times. But the top increases this quarter. Okay, you can see that they added NVIDIA, Uber, Novo Nordisk. That's one of the weight loss drug companies. Meta, Eli Lilly, Thermo Fisher. Okay, you can see that they're actually reducing. Okay, they're reducing. These are some of the ones not in the top 10. So I like to look at the top increases and get a consensus through a lot of these mutual funds and then start researching some of these ones that they're adding, such as Broadcom or Costco. All right, let's look at the next one. Blue T. Rowe Price Blue Chip Growth. This is from 2021. We see they had Alibaba and Tencent, which were Chinese stocks. We've been avoiding those, and PayPal. And he replaced those with Eli Lilly again, ServiceNow, NVIDIA, and Microsoft. They basically doubled their position in Microsoft. Top increases this quarter: NVIDIA, Meta, Eli Lilly, Amazon, and the other ones are smaller. The ones they sold an Apple position, Google, and Visa. All right, that was interesting. One more. This is the last one, I promise. Okay, Vanguard Prime Cap Investor. Okay, so this is just a growth fund from Vanguard. The top 10 holdings, they actually added to Eli Lilly. No, that they actually tripled the position of Eli Lilly since 2021. And they started buying Intel, which is interesting. They're down a lot, and Amgen. All right, so the top purchases this quarter are Eli Lilly. So another Eli Lilly purchase. and Nvidia, JP Morgan. The ones they got rid of are Tesla, Adobe, Abbott Labs. Okay. All right. So that was a good exercise. There was a show called Halftime Report. This is one of my favorite podcasts. A guy named Brian Beltsky, he's a chief investment strategist at BMO, so he's pretty important. He's he was interviewed and he made a list of criteria for quality stocks that will do well in market volatility. So he he said there's not that many lists of good quality stocks out there. So he was suggesting in his talk that the stock market, he thinks that we will retest the lows seen 2 weeks ago, just like Dan Niles said, and that these names would be ones to buy because these names have traditionally done 8% better than the stock market in times of volatility when the stock market's going down. And that's because they're quality stocks. And he gave us his formula. I haven't used this these B plus or higher S&P ranking, BBB minus or higher debt rating. So I haven't used those yet. I'll have to look into those. Um, I do know that it's very important not to have a lot of debt. That's one of our key ratios when we're looking at stocks. But for the fundamentals, he says these are the three most important. And the most important is low earnings dispersion. That means there's not a lot of variability in earnings. So he likes that consistent earnings year after year, very close to the year before, and a consistent growth. Return on equity is improving and free cash flow is improving. He gave a list of those stocks on his list. So if the stock market is going down, he recommends buying these stocks as stocks that are less volatile and more consistent over time. So if these correct in a major way, um, these are the stocks that will basically weather the storm the best and will probably come back better. So the ones that he likes are Amgen, Ameriprise, Chubb, Air Products, Cisco, Alphabet, Honeywell, Coca-Cola, and Visa. And other stocks he liked that he mentioned in his talk was Altria, Walmart, Costco, Lululemon, and On, the shoe company. Um, okay, so yet another guy here that's saying that we might retest the lows. So it looks really great having the stock market go up, a couple of percent in a week. But you got to know that we're going into the worst part of the year. And this Brian Beltsky did say there is seasonality. These are the worst months. Don't be surprised if we go back and retest the lows. And okay, Dan Niles, um, also he basically said whenever we had that 3% drop in the stock market on Monday, 8.5, he said there's a probability we're going to bounce from that. And that was absolutely true. He was right. He said also he's not convinced that the unwind of the Japanese yen carry trade is done. And there might be a bank go under. And if that happens, then the stock market's going to go down. So keep an eye out for that. It's not guaranteed. It might not happen, but don't be surprised. The other thing is, he said, we're not even close to a recession. He said there's still 10% more job openings than people unemployed. Unemployment is still low at 4.3%, and the Fed's going to start cutting. All that shows that we're not going to be in a recession this year. And he also mentioned that we could retest the lows of 8.5, and if we did go down to that level and bounced, he would be much more bullish. So we have another person thinking that might happen. All right. All right. That was my talk for the day. I hope you enjoyed it. And I hope you have a good investing week. And I will see you next time.